When most people picture the power of the dollar, they picture the bill itself. A green banknote held between fingers in an airport, exchanged in a market far from the United States, stacked in vaults, counted on trading floors, hidden in safes, printed in films, sanctions lists, and central bank reserves. It is so familiar that it can begin to feel natural, almost like weather. Of course, oil is priced in dollars. Of course, countries hold dollar reserves. Of course, global trade clears through dollar systems. Of course, when fear rises somewhere in the world, money often rushes toward American assets. In that familiar image, the dollar looks like the world's money because America became rich and powerful, and rich, powerful countries tend to have important currencies. The story can sound almost simple. The United States won the 20th century, the dollar came along with it, and eventually everyone else had to adapt. There is truth in that image. Power mattered. War mattered. American wealth mattered. But the real story is deeper, slower, and much more structural than that. Because the dollar did not take over the world in one treaty, one presidential decision, or one dramatic financial coup. It became dominant through accumulation, through industrial scale, yes, but also through war debts, banking systems, shipping routes, gold flows, central banks, military alliances, trade invoicing, commodity pricing, legal infrastructure, political credibility, and the repeated collapse or weakening of alternative monetary orders. The dollar rose not only because the United States was strong, but because the world kept organizing itself around American strength in moments of crisis, and then finding it difficult to leave that arrangement once the crisis passed. That is what makes the story so important. Because a global currency is never just a currency. It is a map of trust, fear, dependence, and power. When the dollar took over the world, what really expanded was not only the use of one nation's money, but the reach of one nation's financial architecture. American monetary policy began shaping countries that did not vote in American elections. U.S. sanctions became globally consequential because so much of world finance passed through dollar channels. Debt crises, reserve management, commodity trades, and capital flight all became entangled with the condition of the American state and its institutions. The deeper question then is not just why people use dollars. The deeper question is how the world became structured in such a way that using dollars began to feel safer, easier, and more unavoidable than almost any alternative. How did one national currency become the backbone of international trade, debt, savings, and crisis management? How did the dollar survive the end of gold convertibility, repeated financial shocks, inflation, recessions, wars, and predictions of decline? And why has its dominance proven so hard to dislodge even when so many countries have reasons to resent it? Because the dollar did not simply win once. It kept winning in moments when the rest of the world needed a place to go. And that may be the most unsettling part of the story. The dollar took over the world not only because America built power, but because modern global capitalism became so deeply wired through American institutions that even when the system trembles, the instinct is often to run deeper into the thing at its center. To understand how the dollar took over the world, it helps to begin with the currency that ruled before it. In the 19th century, the British pound sterling sat at the center of the international monetary world. London was the great financial capital of the age. Britain controlled trade routes, naval choke points, insurance markets, and an empire on which the sun famously never set. Sterling was not dominant merely because Britain was rich. It was dominant because Britain had built a global system in which trade, finance, and imperial power reinforced one another. This matters because reserve currencies do not rise in isolation. They emerge inside wider orders. Sterling worked because British credibility, the gold standard, imperial reach, merchant networks, and London's deep capital markets all pointed in the same direction. To hold sterling, to borrow in sterling, to ensure trade through London, or to settle accounts through British institutions was to participate in the organizing center of a world economy. And yet, even at its peak, this monetary order was not eternal. It depended on British industrial superiority, confidence in British institutions, and the ability of the British state to sustain open financial leadership without catastrophic interruption. Once those conditions weakened, sterling's dominance would become more fragile than the world had assumed. This is the first big lesson in the story of the dollar. A world currency is never just about money. It depends on who protects sea lanes, who lends in crises, whose markets are deep enough to absorb global savings, whose courts enforce contracts, and whose state appears durable enough that others are willing to tie their futures to it. The pound had all of that for a long time. Then history changed scale. The United States in the 19th century was not yet the center of world finance, but it was becoming something else that mattered just as much in the long run, a continental industrial giant. This transformation was slow, uneven, and often violent. Expansion across North America, the destruction and dispossession of indigenous societies, the growth of slavery, and then the post-Civil War industrial order, railroads, steel, oil, immigration, and the integration of a vast domestic market all made the United States materially enormous. By the late 19th and early 20th centuries, it was becoming one of the world's great productive powers. That is essential to the dollar's rise, because no currency becomes globally central for long without an economy large enough to support trust at scale. People hold reserve currencies not simply because they admire the issuing country, but because they need access to its goods, its capital markets, its legal protections, and the liquidity of its assets. The United States was slowly building those foundations well before the dollar fully displaced sterling. But being large is not the same thing as being central. The American financial system in the 19th century was often fragmented, crisis-prone, and regionally uneven. The United States had enormous productive potential, but it did not yet have the fully mature, globally trusted monetary architecture that London possessed. In fact, the path toward that architecture was shaped by repeated instability, banking panics, deflation struggles, disputes over gold and silver, and the absence of a true central bank revealed how incomplete American financial state building remained. This, too, is part of the deeper story. The dollar did not take over simply because American growth made it inevitable. The United States had to build institutions capable of turning raw economic size into financial credibility. And it had to do so in a world still organized around someone else's money. One of the central pillars of 19th century monetary order was the gold standard. In theory, tying currencies to gold provided stability, confidence, and predictability in international trade. In practice, it also meant that financial credibility became bound to states' ability to maintain convertibility and discipline under strain. The United States' relationship with gold mattered deeply because it signaled whether the country would be treated as financially mature enough to matter at the center of the world economy. Debates over money in the late 19th century, especially around free silver and the monetary consequences of deflation, were not just domestic political fights. They were also arguments about what kind of capitalist order the United States would inhabit and whether international finance could trust it. The eventual consolidation of gold-backed credibility mattered because it reassured foreign investors and linked the U.S. more tightly to global capital markets. But even then, the dollar was not yet king. It was rising inside a world where sterling still dominated trade finance and central banking practice. This is important because monetary transitions are rarely sudden. They happen through overlaps. One currency gains strength while another still holds habit and prestige. The old center weakens before the new one fully solidifies. During these in-between periods, crises matter enormously because crises test which financial systems the world actually trusts when fear replaces theory. And the crisis that changed everything came with war. The First World War was one of the great turning points in the history of global money. Not because it instantly made the dollar supreme, but because it reversed the financial relationship between the United States and Europe. Before the war, the United States was still, in important ways, a borrower and an emerging power. During and after the war, it became a creditor on a historic scale. European powers, especially Britain and France, borrowed heavily to finance the conflict. Gold moved, debt accumulated. American industry fed the war machine from across the Atlantic. The economic center of gravity shifted. This mattered profoundly, because monetary power follows the movement of global claims. If the rest of the world owes you, buys from you, and depends on your capital markets, your currency gains a different kind of weight. The United States emerged from the war richer, more financially central, and less damaged than the old European powers whose supremacy had structured the 19th century. And yet the story was not neat. Britain remained deeply important. London remained influential. Sterling did not simply vanish. The old world tried to restore itself, especially through the attempted return to gold at pre-war parity. But the restoration was brittle, haunted by debt, reparations, political strain, and the reality that the balance beneath the system had already shifted. This is one of the most important hidden features of the dollar's rise. The pound did not lose dominance because everyone calmly agreed the dollar was better. It lost dominance because the old system had been broken by war, and the efforts to restore it carried contradictions too heavy to bear. The United States, meanwhile, was becoming indispensable whether it wanted the role fully or not. Another crucial change came in 1913 with the creation of the Federal Reserve. This was not a glamorous event in popular memory, but it was foundational. A global currency requires not only a large economy, but a central banking structure capable of managing liquidity, providing lender of last resort functions, and interfacing with the wider world at scale. Before the Fed, the United States was too financially fragmented to sustain the kind of orderly influence a global currency demands. The Fed did not immediately create dollar supremacy, but it gave the United States the institutional machinery needed to operate more credibly at the center of world finance. This mattered even more once crises deepened, because reserve currencies are not judged only in prosperity. They are judged under stress. Can the issuing state stabilize markets? Can it supply liquidity? Can it absorb panic? Can it enforce confidence not through rhetoric, but through actual financial capacity? The long rise of the dollar depended on the growing perception that the United States, and especially after further institutional development, could answer these questions more powerfully than its rivals. Still, that answer was not complete in the interwar period. The United States had size, gold, creditor status, and a central bank. But it had not yet fully embraced the burden of organizing world monetary stability. And when the interwar system came under pressure, that hesitation would prove disastrous. The Great Depression shattered the illusion that the old international monetary order could simply be repaired and resumed. Banks failed. Trade contracted. Gold standard commitments turned rigid and destructive. Governments pursued beggar-thy-neighbor policies. Confidence collapsed. International finance, far from stabilizing the world, became one of the channels through which instability spread. This was a turning point not only for economies, but for monetary legitimacy. The interwar years revealed that the world no longer had a functioning center it trusted completely. Britain was weakened. The United States was powerful, but not yet reliably managerial in global terms. Gold remained symbolically important, but increasingly politically intolerable, when defending it required crushing domestic societies through deflation. What had once looked like discipline now looked like a trap. This mattered because it changed what post-war planners would later believe a world currency had to do. A reserve currency could no longer be just a badge of prestige. It had to sit inside a larger system capable of preventing collapse, financing recovery, and managing imbalances. The Depression taught statesmen that global finance left to drift between weakened powers and rigid rules could become catastrophic. And while the Depression damaged the United States as well, it did not destroy the long-term structural truth that American economic scale remained unmatched. The country was bruised, politically transformed, and internally shaken, but still massively productive, still wealthy in comparative terms, still geographically intact. Then came another war, and with it the real transfer of monetary empire. If the First World War shifted the balance, the Second World War rewrote it. Europe and much of Asia were devastated. Britain was victorious but exhausted. France had been occupied and then liberated. Germany and Japan were shattered. The Soviet Union was militarily enormous, but economically scarred and outside the capitalist financial system. The United States, by contrast, emerged with its homeland intact, its industrial capacity enlarged, its gold holdings vast, and its institutions stronger than ever. This was the moment when the dollar became more than a rising currency. It became the obvious foundation for a new international order. That order was designed before the war had even fully ended. At Bretton Woods in 1944, officials from the Allied world constructed a post-war monetary framework centered on the dollar, which would in turn be convertible into gold at a fixed price. Other currencies would be pegged to the dollar. The International Monetary Fund and the World Bank would help manage adjustment and reconstruction. The aim was not simply to crown the United States. It was to build a more stable system than the one that had collapsed between the wars. But it is impossible to separate that ideal from the underlying power reality. Bretton Woods worked because the United States had the gold, the industry, the creditworthiness, and the political stability to anchor it. The dollar was not just chosen in an abstract institutional design. It was chosen because the world had been reordered by war, and only one capitalist power remained with the scale to underwrite recovery on a global basis. This is one of the great truths behind dollar dominance. It was never only imposed, it was also invited, because a shattered world needed an organizing center, and the United States was the only plausible candidate. That did not make the system neutral, it made it effective on American terms. Under Bretton Woods, the dollar became the hinge of the post-war monetary world. Countries rebuilt with American aid, traded in a system whose stability depended on dollar convertibility, and held dollars as reserves because dollars were as good as gold, at least in theory. This mattered enormously. For the first time, the world had a monetary order in which one national currency served as the practical foundation of international exchange, reserves, and confidence, backed not only by metal but by the industrial and military preeminence of the issuing state. That last part is essential. Money is trust. But trust at this scale is never only financial, it is geopolitical. The post-war order did not rest only on spreadsheets and central bank rules. It rested on American naval protection, military alliances, open sea lanes, reconstruction financing, market access, and the broader confidence that the United States was committed to sustaining the capitalist world against Soviet power. So when the dollar spread, American power spread through it. Importers invoiced in dollars because suppliers and banks already used dollars. Central banks held dollars because others held dollars. Firms borrowed in dollars because the markets were deep and liquid. Commodities increasingly gravitated toward dollar pricing because the financial ecosystem around the dollar was becoming thicker, easier, and more globally embedded. This is how world currencies become dominant. Not by formal decree alone, but by network effects. The more people use them, the harder they are to avoid. The more institutions are built around them, the more alternatives look costly. The dollar was becoming less a choice than an environment. And yet the very success of Bretton Woods created its own contradictions. As the post-war economy expanded, the world needed more dollars for trade, reserves, and growth. But supplying more dollars meant the United States had to run deficits and send dollars abroad, which over time weakened confidence that all those dollars could truly be converted into gold at the promised rate. This was the famous Triffin dilemma. The system required the dollar to be abundant internationally, but its abundance gradually undermined the credibility of its gold backing. This is one of the most fascinating turning points in the story because it seems like the moment the dollar's dominance should have failed. By the late 1960s and early 1970s, inflationary pressures, Vietnam War spending, overseas commitments, and growing international imbalances had made the gold-dollar link increasingly untenable. Foreign governments, most famously France under de Gaulle, challenged the system and drew attention to the privilege the United States enjoyed by issuing the world's reserve currency. Then, in 1971, Richard Nixon closed the gold window. The dollar would no longer be convertible into gold. In theory, this should have been the end of dollar supremacy. The whole Bretton Woods logic had rested on the promise that the dollar was anchored to gold. Once that link was severed, why would the world continue trusting it? And this is where the story becomes especially revealing. The dollar did not collapse, it adapted. The survival of the dollar after 1971 is one of the great puzzles only if we imagine that gold was the real source of its power. By then, gold mattered symbolically. But the deeper foundations of dollar dominance had already become larger than gold. The world continued using dollars because the United States still had the deepest financial markets, the strongest legal infrastructure for large-scale capital, the most liquid government debt, the most powerful military, and a central place in trade, investment, and alliance structures. In other words, the dollar no longer needed to be as good as gold if it had become, in practical terms, more useful than gold. That is one of the most important lessons in the entire history. Reserve currencies survive when they become embedded in systems of convenience and fear. The dollar was convenient because it was liquid, widely accepted, and backed by vast markets. It was also protected by the fear of alternatives, because no other currency zone offered the same combination of openness, depth, military protection, and institutional reliability. The 1970s did introduce new strains. Inflation surged. Oil shocks destabilized the world economy. Exchange rates floated. The old fixed rate order was gone. Yet even in this instability, the dollar remained central. Why? Because trade still ran through it. Debt still ran through it. Commodities, above all oil, increasingly remained priced through dollar systems. Banks used it, states needed it, private actors preferred it. And when disorder rose, the instinct was not to flee the dollar world entirely, but to seek shelter inside the most secure parts of it. That paradox has never fully disappeared. The 1970s also gave the dollar another structural advantage: energy. Oil was not always priced and politically structured around the dollar in the way later shorthand often implies. But after the upheavals of the 1970s, the combination of Gulf oil exports, U.S., Saudi strategic ties, and global energy trade further deepened the role of the dollar in world commerce. Oil producers earned large surpluses in dollars. Those dollars were recycled through Western banks and financial markets. Countries needing energy often needed dollars first. This mattered because energy is not just another commodity, it is a master input. If one currency dominates the pricing and settlement of the world's most important energy commodity, then its position in reserves, trade finance, and international banking becomes even harder to dislodge. The dollar was not simply surviving after gold, it was thickening its role in the arteries of global necessity. At the same time, U.S. Treasury markets became more central as global safe assets. If countries needed reserves, if banks needed liquid collateral, if crises created fear, American government debt offered scale and reliability unmatched by most alternatives. This is another crucial hidden cause of dollar dominance. The world does not just need a reserve currency. It needs assets denominated in that currency that are deep, tradable, and trusted in crisis. The United States could provide those on a scale almost no one else could. And every crisis made that more obvious. One of the reasons the dollar took over the world so thoroughly is that it kept becoming stronger during crises, even crises partly generated by the US-centered financial system itself. This seems counterintuitive until you understand how centrality works. In Latin American debt crises, Asian financial turmoil, the 2008 global financial crises, the pandemic shock, and repeated moments of global panic, actors around the world needed dollars to service debts, stabilize currencies, fund trade, and secure balance sheets. The Federal Reserve, in effect, became not just America's central bank, but a partial lender of last resort for the dollar world, especially through swap lines and liquidity facilities for key partners. This is extraordinary. It means the United States issues the money everyone uses in bad times, and when bad times arrive, demand for that money often rises rather than falls. The more globally indebted and interconnected the system becomes, the more dangerous it is to be without access to dollars. This gives the United States enormous structural leverage. But it also means the rest of the world is living inside a hierarchy of monetary dependence few people voted for explicitly. And this is how the dollar stopped being just America's currency and became something closer to the operating system of global capitalism. As the dollar became more central, another form of power expanded with it: legal and coercive power. Because so much trade, banking, and settlement passed through dollar channels or through institutions exposed to U.S. jurisdiction, Washington acquired the ability to use access to the dollar system as an instrument of foreign policy. Sanctions became more potent not only because the United States was militarily powerful, but because exclusion from dollar clearing, U.S. banking relationships, or access to American financial markets could be devastating. This is one of the most consequential ways the dollar changed the world. A reserve currency does not merely reduce transaction costs. It creates asymmetry. It allows the issuing state to monitor, pressure, freeze, and punish with remarkable reach. Sometimes this is used against regimes many people oppose. Sometimes it creates resentment even among allies. But either way, it reveals that the dollar's role is not neutral. The world's money is also an arm of one state's legal order. This has fueled repeated efforts to imagine alternatives. Europe has wanted greater monetary sovereignty. China has internationalized the renminbi in limited ways. Other states have discussed non-dollar payment systems. Digital currencies and regional arrangements provoke new speculation every few years, and yet the dollar remains at the center. Why? Because displacing a world currency requires more than frustration. It requires building a full alternative ecosystem of trust, law, liquidity, capital mobility, safe assets, settlement infrastructure, and geopolitical credibility. Resentment alone cannot do that. Most challengers can supply pieces. Very few can supply the whole. So how did the dollar take over the world? It took over because the old monetary center, sterling, was weakened by war and imperial decline, while the United States became the world's largest industrial and creditor power. It took over because American financial institutions matured just as global crises revealed the inadequacy of the older order. It took over because Bretton Woods embedded the dollar at the core of post-war reconstruction and trade. It took over because the United States underwrote not only a currency, but an entire geopolitical order in which markets, sea lanes, alliances, and legal frameworks pointed toward American centrality. It took over because even after gold convertibility ended, the deeper supports of dollar dominance, market liquidity, treasury debt, legal reliability, military protection, energy pricing, and network effects had become stronger than gold itself. It took over because every new layer of global integration made using dollars easier than not using them. And it kept taking over because in crises, the world repeatedly discovered that it needed dollars most when it trusted the system least. That is the strange genius of the dollar system. It is not loved everywhere. It is not neutral. It is not invulnerable. But it is deeply embedded, and embedded power is among the hardest forms of power to replace. The story of the dollar matters because it reveals something larger than finance. It shows that global power in the modern world is not held only by armies or factories, but by the infrastructures through which trade, debt, savings, and fear are organized. A reserve currency is not merely a monetary convenience. It is a form of world-ordering power. It shapes how states survive crises, how companies borrow, how commodities move, how sanctions bite, how central banks think, and how risk is imagined. And perhaps the deepest lesson is this: the dollar did not take over the world because it was perfectly designed in one stroke. It took over because every major alternative order, imperial sterling, interwar disorder, gold discipline, post-colonial monetary fragmentation, and later rivals, kept colliding with crises that pushed the world back toward the system already dense enough to absorb panic. That is why the dollar story is not just about American strength, it is about global dependence. The familiar image is still there, the green bill passing from hand to hand in places far from the United States. But the real story lives in war debts, central banks, oil contracts, treasury auctions, emergency swap lines, shipping insurance, development loans, sanctions offices, and the quiet decisions of thousands of institutions choosing what to trust when everything else feels uncertain. That is how the dollar really took over the world. Not by magic, not by one treaty, and not by paper alone, but by becoming the language in which power, liquidity, and safety were most often spoken, until the world found itself using one nation's money not because history had ended, but because history kept breaking in ways that made the center look, again and again, like the only place left to stand.